Good evening, everybody. My name is Graham Virgo, and I'm the Master of Downing College. I'm delighted to welcome you here this evening for a Downing debate, what makes a good economy? And we have got five alumni of the college who are going to answer that question for you. I'm going to let others introduce them, but I'm going to introduce Simon Wilson, who is chairing this session, former head of journalism at BBC Worldwide. Welcome all of you, and Simon, over to you. Thank you very much.
Graham, thank you very, very much. And as I said, there's so five of us here who studied here, but none of us were here when this was built. So it feels like we've either gone forward in time or leapt back in time to the Elizabethan age and find ourselves on a Shakespearean stage in front of you. I was just explaining to the others, I'm just back from the United States where I was chairing a panel on the Israel-Gaza conflict. So I'm hoping that today will be lively, but not too lively. That was a little bit, you can imagine. A couple of quick things to talk about just before we start. Please put your phones on silent or turn them off. And in the unlikely event of a fire, that's the fire exit behind you, and we all assemble outside. That's the air steward bit over. Let me introduce the panel, and we'll get straight into some questions. So as I said, we're all Downing alumni of various generations, well, pretty much the same generation. Ashley Alder is now chair of the Financial Conduct Authority, the main financial regulator here in the United Kingdom, as many of you know, a position he took up earlier this year, and before that was CEO of the Hong Kong Securities and Futures Commission. Before that, Ashley worked as a partner and head of region for Herbert Smith, one of the big Hong Kong law firms. Gareth McCartney is managing director and co-head of global equity capital markets at UBS. Over 20 years' experience with some of the world's leading investment banks, including Goldman Sachs and Merrill Lynch. And Gareth's work focuses on advising governments, corporates, private equity and entrepreneurs on equity finance, if I've got that right. Julia Harrison is global head of public and government affairs at FTI Consulting and has more than 3 years of experience, or more than three decades of experience working in public affairs and communications in Brussels, London and Washington, DC. Julia helped set up the Women's Forum for the Economy and Society and was a non-executive director at the Sustainability Institute think tank. Julia, importantly for some of us, is also president-elect of the Downing College Alumni Association. And finally, but not least, Darren Redmayne is CEO of the advisory arm of a pensions and asset management firm called Cardano. I'm told not to be confused with a cryptocurrency of the same name.
I get asked that a bit.
I might ask you about that later. Darren has over 25 years' experience working in financial services, including helping to set up the UK pensions regulator in 2006. And after that, he founded a pensions advisory business called Lincoln Pensions, which became Cardano. So we're going to, first of all, start off with a little kind of starter for 5, or is it 10 these days on University Challenge. Just a quick few headlines on broadly what makes a good economy. Ashley, I'm going to come to you first.
Right, okay. Well, the disclaimer is I'm not an economist. So I've written down a few lines here about what I think could make a good economy. Then I'm going to say something possibly in opposition to that. The characteristics I've identified are strong, democratically accountable institutional frameworks capable of limiting destructive boom and bust cycles and supporting the conditions for growth and promoting fair economic outcomes across civil society. Actually, I don't think that means much at all. I think the reality, certainly from my position as recently appointed chair of the FCA, is that we're constantly attempting within whatever political economy we operate in to deal with economic cycles and economic crises and working out what tools that are available in relation to that. And I think just we're in the UK, I'm the chair of a UK regulator. I think the situation we are in at the moment essentially is that there is virtually zero fiscal room for manoeuvre, whichever government wins the next election, to do a great deal in terms of taxation, spending, or raising further debt. Basically that means that given where we are with low productivity, and it's been the case for years and years and years, that would imply structural change to stimulate growth. And we can come on to this later, but that is really, really, really hard. But it's a challenge that has been very explicitly put down for our organisation to think about and do something about, and others as well. But I'll leave it there.
Thank you. Gareth, what makes a good
Right.
economy?
Okay, complex question, but I think from my side it's really about a mechanism for being able to allocate scarce resource. I think the foundations have got to be world-class institutions. I think we're sitting in one today, and that's really around education, business, governments. And then underpinning all of that, I think really, and one of the challenges consistently, whether it's politics or economics, is just the duration of the ability to make decisions. So I think having very strong rule of law and strong governance, which allows allocators of capital to be able to make genuinely long-term decisions with confidence around the framework that they're doing that, is critically important. If you look at just building on some of the challenges today, I think there's three main themes that are driving volatility in political cycles and in asset prices, and I'd define them as really three things, which is firstly, we've got this decarbonisation agenda, so we're going through a big energy transition. Secondly, we've got a generational repricing of interest rates, which is underpinning a lot of the economic changes that we're seeing. And thirdly is almost a deglobalization agenda as well. And if you bring all of those things together, that is driving, with technology accelerating the pace of this change, a pretty uncertain outlook for a lot of both individuals, corporates, and also governments, who I think historically have done well when change is slow and linear, but when change becomes exponential and volatile, becomes a lot more challenging. So really it's about rule of law and trying to make long-term decisions to allow allocators to take long-term strategic decisions rather than tactical crisis management decisions.
Thank you. Julie, you're based in Brussels
Yes,
these days.
yes.
Do you want to just sort of pick up, and how does a good economy look from there?
Well, I mean, picking up on a couple of the ideas that have already been mentioned, I think that stability really is something that any corporate or any business who's trying to interact with government, which is my area in Brussels and more broadly, is looking for. And I think that underpinning this kind of move from the globalized world to a more interventionist, active government environment, which is what we're seeing, it just creates this volatility. All the things that you mentioned, I think, are true right across Europe. And it's very hard to actually, get a longer-term decision-making platform when you have so many things, whether it's, geopolitical risk that we see in, from wars to de-risking China, AI acts, which are different in UK, in Brussels, in the US, whether it's the string of really important elections we've got coming up over the next 12 months. It's just a very difficult environment for governments to get politics, policy, and regulation in harmony and in balance. And I think they're three quite different things that have to be sort of balanced, and I don't think they are at the moment. So maybe that's what's causing a problem rather than what's there for a good economy.
Yeah. And Darren, your company is very big on sustainability and long-term sort of planning. From your point of view, what's this? Just to come back to this good economy question.
Well, I think a good economy should work for the younger in society, and also as we progress through the demographics, the older in society. And I'm not sure at the moment, as I reflect, that the economy and most economies in the sort of traditional Western world, if we call it that, work that well for the young at the current time. And if I was just give a few reasons why I say that, well, there's a bit of good news for everybody, which is that life expectancy generally has been getting longer and people are living longer. But that means there are more proportionately older people in society that are living longer that increasingly need to be funded by those in the productive economy, if we call it that, that are younger and working. And that is becoming, in terms of fiscal headroom, harder and harder and harder. If you look at wealth and where wealth sits, the vast proportion of wealth sits with the older in society. And that is not necessarily because of savings, that's because of property wealth and asset growth and this generational period of low interest rates that we did have that we now may not have. Going back to, if you're younger at the moment and trying to, buy a property. And then lastly, I guess, just in terms of, we have, look at the UK, 2.6 trillion of national debt. And that is, going to, again, to your point around fiscal headroom, actually, we have borrowed from the future generations, the younger in society, to get us through some pretty horrible stuff, including most recently, of course, the COVID pandemic. So when you sort of think about the social contract between the younger and the older in society, I think it's being tested to the limits.
Yes.
Does anyone else want to come in on this?
Yeah, I think I'd fundamentally address it. Duration is the most important topic, and I think given all the previous comments, we're going through these enormous transitions around cost of money, decarbonisation, deglobalisation, and they play out in these ways. And you can have a much bigger discussion philosophically about what government's right or political system, but ultimately I think the advantage to some extent of the Chinese example is they can take a very long-term strategic decision-making process because they haven't got the mark-to-market of an electoral cycle or some of the fiscal constraints, which means we've got this inherent volatility in power struggles. And so you can take a long-term view, and I'd say, going back to this sustainability point, if you are making an energy transition, which we did in the Industrial Revolution, where we went from burning wood to burning coal, we then translated into gas, we're now into a much more complex energy transition to renewables, which ultimately the economic return on that maybe is not as quick or otherwise. If you're in a Chinese world, you can take a 50-year view, and that's just what everybody's doing. If you're in the Western world, where effectively we took a lot of those things off balance sheet, and we're now in a deglobalizing economy where we now need to bring it back on balance sheet, I think that's quite an interesting debate. So for me, it comes down to duration. Chinese example, you can take a long-term view, you don't get questioned, and you just do it. In the more Western world, where you've got these turnovers, policies changing, and I think that makes, again, very difficult for allocators of capital with any conviction to make these decisions.
Sorry, can I just come back to Darren, particularly on that sort of sustainability? What do you say to your clients? Because presumably that's a core part of your business is persuading clients that they need to invest in the long term.
Yeah, and we persuade our clients by having to remind them that it is the right thing to do. I mean, it does sort of start there really, and it starts around belief. So a huge amount of our clients at our firm are pension funds. Pension funds, if you take one of ours, which is Now Pensions, is an auto-enrollment, so it's a large number of young people that have been auto-enrolled into the scheme, and they are saying, well, look, we want our pension funds invested in ethical investments, in investments that we see that can be part of the transition. We would like certain things to be excluded. Some of it is driven by effectively member appetite and effectively consumer demand, if you like. But then yes, there's a fair amount of sort of persuasion of traditional asset managers that there is you can generate returns, you can generate attractive returns as well as pursuing call it a green agenda. It is possible to do both things. It doesn't have to be the case that supporting the climate challenges that we have and the productivity challenges that have been referred to necessarily mean that you have to sacrifice return. So it's these sorts of debates that we're having to persuade people to allocate funds.
Julia, did you want to?
Yeah, I mean, I think that there's a lot of polarization in policy making, at least across Europe at the moment, and so there's very little. There's the same limited room for manoeuvre in the middle. I think when you're trying to get businesses to invest and use technology at speed to, let's say, make the energy transition, that's got a lot of pressure from the outside in terms of just in terms of energy security, in terms of the lobby that you see from oil and gas still, and it's really polarized. So there is very little kind of room in the middle where you're actually getting a discussion going on that then kind of produces the results in the political world. So, and I think on the time and duration point, you're seeing governments start to talk about that. If you look both at what Sunak was saying, I think very recently about long-term decision making, if you look at what Labour's put in their work programme, they're both talking about that. But the pressures around are making it they make it very hard to do that in an unplanned economic and political system. And if we're moving much more towards intervention and an activist government, you're a bit stuck when you can't set a more, rigid, let's say, framework around it.
I mean, it brings us to one of the kind of core issues here, which is the tension between, maybe it's not a real tension, but it seems like a tension between free competition and regulation. That seemed to be a sort of, is that at the heart of making a success of an economy?
Not really. I think we've had points of disagreement, which is great for a panel.
Okay.
So,
You're pointing at me as well. Looks like that. Julie's in the way.
Sorry, I'm just not. I'm not avoiding your.
No, please.
Yeah.
So I think there's that point about duration. When it comes to climate policy, well, first point, I think I don't actually think that the way in which many autocracies behave. They say it's long-term decision-making over 50 years. In fact, it isn't.
Sure.
It's very, very reactive. It's, in essence, very similar to the way in which somewhere like the UK behaves, which you will have events, you will have crises, you will have market cycles. In China at the moment, they're really struggling with the economic downturn, the property crisis, and all that kind of stuff. So they're kind of dealing, and they're addressing it with the same sort of tools that we would in the short term, and that pushes away in reality, the long-term thinking. So I don't think there is necessarily comfort.
Do you want to expand on that at all?
Well, I guess there's a couple of things. I think, first of all, in the companies that we speak to today, one of their biggest agenda points is aligned. They understand this transition is real, their stakeholders care, they need to get this right. I think from the government perspective, I think there's a fundamental challenge, which is we've come from a decade plus of free money, effectively, and that's now repriced. And inherently, there's inflation, because Friedman said, it's always a monetary phenomenon. We've had the biggest money printing of all time over the last few years. So we have an inherent money supply-driven inflation. And then on top of that stress, you're also adding in some of the inflation that's coming from this energy transition. And you're also seeing the structural issue whereby, nominally wages keep going up. There's a lot of things in the economy that are quite transitory. So I don't think inflation is going to be transitory whatsoever. We saw this in the 70s. We came out of the 1960s, which was free money, free trade, growth. 70s was actually challenging. And I think the lesson from that was you're going to have rates higher for a lot longer than you feel comfortable with. I mean, we're 20% interest rates in the US. It took from Volcker to deal with that. So I think the challenge, which is where I come into this duration point, is there's unequivocal consensus that transition and green is right to do. Corporates, governments, individuals, generational gaps. It's just how do you actually execute that in a time frame that's acceptable or tolerable when you're coming into it with all the fiscal constraints you talk about and an inherent inflationary problem, which again addresses directly to the people in society who are having to work and pay for this through higher energy prices in the short term. So I think that's the comment I was making about how you work through this, which in a 4-year electoral cycle, or as we've seen recently a 1-year cycle, that's very hard to implement relative to some of the advantages the other command economies have, where they can take a much longer view and don't have that stakeholder mark-to-market. I think that was where
Well, I mean, to just go back to this duration and timescale point, and at risk of repetition, I mean, one of the reasons why pension fund money has a role to play in climate transition, and why obviously my organisation is aligned to that, is because it's a long-term saving. And long-term saving over number of decades with a view to hopefully at the end of it having a pot that will be large enough to give you a sort of comfortable retirement. So you can take, and the custodians of that money, and in terms of either the members themselves or the trustees that are looking after those pots, are investing over decade-long horizons, and are able to say, well, we can do some impact investing, we can do some things where we just need to make sure that we generate a return in a way that is consistent with our objectives. So, in a sense, finding pools of capital which can have a longer-term horizon is quite important to that sustainability agenda.
I want to just move on because time is limited and we do want to get to some questions, but just to throw into this mix, if it wasn't complicated enough already, I think it's now, it's actually illegal on any university campus to have a panel discussion without mentioning artificial intelligence. So who would like to sort of pick that up and talk about the impact AI, machine learning, other innovations can have on the economy?
Okay, I'm picking up. So look, no, I think that jokes aside, I think, look, if you look at the last few years, what's happened is we've had every political response to a crisis has been print more money, cut interest rates. We had that through the global financial crisis, COVID, and obviously the geopolitical concerns. That money has got to find homes for itself. And I think what we've seen over the last few years is these bubbles forming, whether crypto is a good example of that. We saw an equity market continue to re-rate because if you're getting no return in a bond or in your bank account, suddenly actually an equity giving you a dividend yield, that makes sense. So I think really what we've seen is we're still working our way through excess liquidity in the system and finding these bubbles. So I think purely from a capital markets perspective, AI is the next big hope as we see it today. We're seeing disproportionate amount of equity investors looking to find a narrative in the market. It's difficult to find them for all the challenges we've outlined. AI is now the next big growth opportunity that they see. And so we are seeing almost unlimited amount of equity capital available to pursue AI situations. Whether you go back to the tulip bubble, the deep sea bubble, there's been bubbles all the way through history. I think from a capital market, that's a risk in the short term from an equity perspective, but there's zero doubt that actually, and you can see it from the response from governments now as well, looking to regulate and how they regulate that this has actually going to have a real impact on society in terms of human engagement in the workforce, productivity, which might help, to your point, address the productivity issues we've had in this country. And then thirdly, I think the equity market is there to support this, and they're going to give it a good go. So we're going to see naturally, I think, how it evolves.
I mean, I think one of the interesting things about AI is what happens in the broader kind of industrial strategy and innovation, because you've got much more interest from governments now in actually setting industrial strategies, in looking for, across Europe, strategic autonomy, and actually, working in a way to try to fund that. If you look at the IRA, the Inflation Reduction Act in America, or the net zero piece in Brussels. But what's happening at the same time is the regulation around AI is being quite defensive. So it's about protecting jobs in the workforce or trying to reskill in a different way so that AI doesn't wipe out sectors. It's about gender bias. It's about all types of bias and making sure they are not built into AI models. So it's quite defensive. And there's always been a sort of a gap, I think, in terms of how government can help innovation. And so, it tends to be defensive over here, and in the US it's more, push money and let it go. So I think that whole kind of ability to actually regulate correctly in the right way, but actually allow the innovation to sort of take force, is the key question.
Well, I'm a regulator, so I'm naturally defensive, and a lawyer, which makes it even worse. I think just the way we're looking at it from that perspective, and where we look at risks. There's two things happening in relation to big tech at the moment. The first one, which is fairly imminent, is the identification of what we call, the jargon is critical service providers. That's cloud and similar, which is massively concentrated power over the technology and the data. And effectively what the proposal, which I think will happen, is that the activities that could have a systemic effect, systemic negative effect on the economy as a whole, those particular activities will start become regulated by the FCA, in fact, and others. So that's one piece. But that's only to do with big tech providing services like cloud, on which so many businesses, including financial services, banks, etc., are utterly dependent. And to date, it's been the approach has been you, the bank, say, need to make sure that your service provider gets it right. It's your responsibility. So we're shifting the focus directly to big tech. That's stage one. Stage two is the question of where does the power lie? Again, it's data, technology, and such like, which enables or is enabling a transfer of activities from a traditional sector to a tech sector. And that really boils down to a very, very difficult conversation about sort of same activities, same risks, same rules approach. If you follow that through, you will start defensively regulating big tech much more closely. Now, the problem is that you may have seen, I don't know, Nick Clegg wrote something in the
today in the Guardian.
You know,
Yeah, I think
the
it was.
lobbying power of big tech is extraordinary. So I'll just leave it there.
So let me be the AI
Absolutely.
optimist. So as has been spoken about, we need to find a step change in productivity. We need another industrial revolution, and we need an industrial revolution that doesn't create lots of carbon dioxide by burning up fossil fuels. And there's no fiscal headroom, so we need to find a productivity leap to be able to pay for everything. And my hope around AI is, I feel that I am a Victorian watching a steam train, and I feel like I might be in the 1950s, turning on my television for the first time. I am of an age where, my email address, I started to use email here. The first time I ever sent an email was at Cambridge when I was an undergraduate. The first time I used the internet was after I left Cambridge. And it's an enabling technology which has the potential. My worry now, to sort of perversely flip back to that side for a moment, is we haven't regulated the last technology wave around social media, which is causing, I think, a huge amount of mental health harm. That's as bad as smoking was, just to mental health. We haven't regulated or got our arms around that. So Bletchley Park, which is today, and efforts to try and get our arms around this. I hope we do a better job without sort of getting in the way of what could be just an incredible enabling tool, in the same way we all have phones and computers and can't live without them to drive hopefully forward the productivity gains we need.
And I think it's also something that the UK and actually this university as well should be absolutely and has been at the forefront. I mean, ARM has been one of the great success stories of the UK, which generated from again this university. So again, it's something that rightly regulated, rightly controlled, but it is another growth area that the UK should be front and centre of, which is positive.
Well, interesting actually, whilst we got Ashley, ARM took its public offering over to America, didn't it?
It certainly did.
Yeah.
And that was 2 weeks after I joined the FCA, and there was a weekend FT headline which said, FCA to blame for ARM going to the US.
Yes.
Blame was definitely the word there, so that was a great introduction. But it comes to, I'd quite like your, if comment on this, if I'm able to ask her.
Yeah.
So there's the near term push at the moment to, and it's a structural change, to boost productivity and boost growth, which I think both main parties will pursue, so whoever is going to, is this drive to mobilize what is seen to be dead capital or dead savings or undeployed savings in the UK. So the focus mainly is on pension funds who are going to rather famously are only invested in their assets. As a proportion of their assets, it's about 2% of their assets in the UK. So the obvious question is, my God, we've got this vast pool of money. If it were invested in the UK, you'd have much greater demand. That would then affect decision-making, among others, of where you list. Because the reality is the gravitational attraction of the US to firms like Arm or SoftBank, in reality, who were,
I was going to say
who were making the decisions, is massive. So, but nevertheless, there's this push at the moment to use various levers, some of which are in my organisation's hands, some of which are with the pension regulator and similar.
Yeah, so
in
the
order to
Mansion
consolidate.
House rules recently which is again, an attempt to try and mobilise these pools of capital and say, look, why are you just buying government bonds? Because pension funds, you're thinking over the long term, you want to be safe, so you bought a lot of government bonds, but actually we would quite like you, since you're taking a longer term view, to put more into riskier, less liquid, more venture type investments. Even if it was 1 or 2%, the pools of capital are so vast, it would actually make quite a substantive difference.
This topic
Well,
is...
quick point that I want to...
Yeah, be very quick.
Yeah.
This is the biggest topic for us. Every company we talk about is they want to go to the US, but actually when you disaggregate the question, there's a lot of myths. As a non-US company listing in the US, the aftermarket is extremely challenging. So a lot of the reasons to go there, more liquidity, better valuation, when you underpin it all, that doesn't necessarily hold. I mean, that's a much bigger debate, but we should come back to that.
So I'm going to just quickly get a wrap up here, and then we want to come for questions. And I've asked all our panelists in advance to have a little think about a prediction for the next 12 months. Julia, do you want to start? Where do you think we're heading with all this?
I think that there'll be a continuation of more regulation, more intervention, more active government that we've seen since the pandemic. You've got elections in Europe in June. You've got elections in the US in November. You've got the UK election latest, I think, by January 2025. So, we've got a series of fairly major critical elections. And I think, we'll just see that trend. And even right of centre, which governments which are coming in some places in Europe, even at local and state level, are not leaving sort of taking a liberal market approach. They're taking a much more interventionist approach. It's going to continue.
I'm going to make my prediction. I think the UK is going to be a really interesting place to invest in the next 12 months. But it's going to require us being very bold. The time is now to do it. As mentioned, there's a lot of regulatory focus. You've got new government. This is a great time for a reset in the UK. We can double down in things like AI. We can hopefully unlock some of this pension funding to come back into equities, and we get some more Keynesian animal spirits to invest back in the UK, take some more risk, and there'll be more upside.
Darren, are you as uplifted as that?
I'm pretty uplifted. I think the thing, and I'd pick up on a comment that Gareth made earlier, actually, I think inflation is persisting, and was it Rishi who said he wanted to halve it by the end of the year or something like that? So I think my prediction is that won't happen, and that it's going to be a tougher journey, and that again slightly plays to my point earlier that if you're a bit younger in society, it's all the tougher perhaps at the moment. But I am optimistic. But I just think the inflation challenge is sort of weighing things down a bit.
Ashley, a closing thought.
Well, I wish I could really be optimistic. It's it's just not in my nature, maybe. It's a combination of being a lawyer and then a regulator. It just it sort of squeezes that out of you. I just think that there's just for prediction for the next 12 months, there are just too many short-term domestic issues and geopolitical issues, getting in the way of ability to predict anything, because events will drive the agenda. I think it's absolutely right. I think we need to adjust to higher interest rates for longer and higher inflation. We haven't got through that period of adjustment yet at all, and it actually came as a really big shock. It was years and years of low for longer interest rates and all that went with it. That built a whole series of vulnerabilities, particularly the size of both household and government debt. When interest rates goes up, that's basically the whole sort of when the tide goes out, you can work out who's wearing swimming trunks. So and I think we're in that kind of era. I totally agree that because of that and because of the uncertainties, that government intervention will be very, very noticeable. I think one example of that is, I think it will happen, actually. Whether it's going to be successful is another matter, but the government and regulators push to force more risk into the system in an attempt to deploy trapped capital to stimulate growth, with the theory that in the longer term, that gives younger savers, because after all, pension schemes that people have now, which are defined contribution pension schemes, aren't actually pension schemes, they're investment schemes. And they need to understand that. So if you drive more risk into the system, it should provide a longer term better returns for the younger population over time, and it should drive their savings, whether through pension funds or otherwise, into productive investment. When I say should, the question is, will it? And will it work to get us out of the productivity trap, which is the basic problem we've been dealing with for years and years and years? Sorry, so that's not a prediction.
Well, it's pretty
It's
good.
just it's a bit of a moan, isn't it, really?
It's a pretty good summary. Well, thank you all very much. And I said we were determined to keep some time open for questions. So I think, Alicia, do you have a microphone?
Yeah.
Do you? So if people could put their hands up if they want to ask a question. I think we have one already pre-prepared, but if you could introduce yourself and ask your question, and then please afterwards, please try and catch my eye, and I will be beady-eyed and looking around the room. But yeah, our first question.
Hi, I'm Michael Ashbury. I'm a fellow in economics at Downing. My question is about the idea that businesses should behave responsibly, which has been gaining popularity for a very long time. To the extent that it's not profit maximising, Milton Friedman said back in the 70s that this amounts to spending other people's money for them, and you should let them spend their own money themselves. So my question is, what does the panel think of the idea that businesses should behave responsibly, and Friedman's critique of it?
Who wants to take that?
Look, I think there's two questions. I think one is for public companies, their shareholders every day have the opportunity to judge where they're at. They can buy and sell the shares, and the management and the board are under pressure for that. So I think, to Milton Friedman's point, ultimately the stock market in the public context, your shareholders take control of that, and they're going to decide if you're doing the right things or not, and they can employ whatever metric to that it is. It might be sustainability, it might be classical returns on investment. I think there's a secondary component to this world now, which is the amount of private companies today is bigger than it's been before, and the scale of assets supporting those companies means there's much bigger companies that are no longer in the stock market arena. And one trend we are seeing around that is some of the money supporting those companies is more family offices with much longer duration who've got much more of a moral guidance as to how they want those companies to operate. But I think fundamentally in the public markets, the reality is that the stock market is going to rely on returns, and that's what's going to drive performance and therefore success or not. And this comes back to this point around government intervention, where we perceive to be market failure in the private markets, that they'll intervene. And as we've seen with this whole energy transition story, they're there to provide subsidy, they're there to provide the mechanism that they can do to prevent the, I guess, stock market being much more materialistic and deliver on some of these public goods that actually would be better served either in a private context and private ownership with benevolent sponsorship, or sitting with the government intervening and funding these efforts, I guess.
Yeah, I mean, I'd just add that I think that the societal expectations around companies behaving responsibly have really changed or come to the fore. And I think that has made a difference, significant difference to what companies pay attention to every day. And then, you know, you've obviously got a spectrum of how much a company will involve itself in something which you will label responsible activity. But I think that spectrum, you know, you've got a much broader group that are involved in that now. And yeah. I think that the trick, or where it seems to sit most happily, at least with the businesses that I've interacted with, and in terms of their reputation with governments when they're trying to talk to government too, is where you've got a complete combination of, you know, the commercial interest and the responsible interest, if you like. And that's not necessarily environmental, it can be societal or, you know, another aspect. And that's the most happy place, I think.
No, not at all. I mean, just to echo that. I mean, companies are run by people, and to be commercially successful, you want to attract the very, very best talent. And quite rightly, the talent says, well, I want to work for a company that has a good purpose and that has good values and thinks the way and is thoughtful about these sorts of issues. So in fact, to be commercially successful and to generate the sort of profit maximizing environment, there's also, obviously clearly a huge amount of factors. Then the only other thing I was going to say is that I've experienced a little bit through my career is the sort of the company is profit maximizing and charities are for good causes and do good things. I mean, they're all run by people, and you get governance failures, and you get issues in all of these sectors. So there's a spectrum, and there's, I guess I'm making the point that companies aren't necessarily universally bad. In fact, a lot of, I'm not saying your question is suggesting that, but a lot of profit-oriented businesses are trying to do good as they generate those profits.
Yeah.
Just I think one last addition is, if you look at where funds have gone, primarily the issue for stock market, most funds recently have gone into index tracking funds. Actually, where we've seen the most inflows into actively managed funds has actually been into the ESG orientated funds. And you can pretty much prove out with a company, if it gets the ESG part right, attracts more Article 8, Article 9 capital, and that actually drives value. So again, it goes back to my point, the shareholders will hold them to account, and we're in an environment now where ESG is a big driver of what shareholders are looking for, and most importantly, will value in the stock market, and I think that's self-fulfilling and driving a better approach to sustainability.
I think it's going to fall stick to me. I mean, the profit maximizing versus the doing good discussion. So just to give you just one illustration, about 2 weeks ago in the UK, we with others launched the framework through which companies can describe the way they're going to handle the transition. It's called net zero transition planning. And that basically forces companies, public companies initially, to recognize what either their own stakeholders or governments are expecting, and some are legal commitments around net zero, see it as a reality, which is, whether it's 2050, whatever it might be, and then disclose how their strategy, their corporate strategy over a period will align with that. And it's to do with the cost of capital, because if you don't do that, there'll be a high level of skepticism. You just don't get it. So your business is vulnerable, and therefore you'll be derated. If you do disclose it, and there may be a set of difficult choices that you're disclosing against, then investors can align their own choices against that disclosure. And that underpins a lot of what, again, regulatory and government sort of intervention is doing, which is driving an information environment which now allows the providers of capital, whoever they are, to make choices which are aligned with profit maximization, cost of capital and such like, but also recognize that this is a big nudge to get with the program around net zero.
Thank you all. I think there was a question just at the back. Lady at the back had a question. There you are. Thank you.
Hello, Stefania Fiorentina. I'm a fellow in land economy here at Downing. So I'm not exactly an economist, but close to it, let's say. I work in economic geography and urban planning, so maybe my question might feel a little bit provocative. I guess if I had to add something to the title of this panel, would be what makes a good economy for whom? And of course, one of the challenges we live, we face in our society nowadays is the polarization of society and the increasing socioeconomic divide that is caused also by all the other economic challenges that you have highlighted. So I guess my question for you, for the whole panel, is what do you foresee in the future in terms of measures to bridge this gap? We talked quite a lot about the role of government in making good economies. What about the social aspects of making the economy fairer? Whether this includes ESGs for companies, but also more widely.
One question. What's your essential question?
What's the role of the government in making economies fairer in the future?
Right. Well, we have not the government, but we have the regulator with us.
Yeah, regulators
what's
is
the role of the,
fine as well.
The regulator.
Well, we've got 3 statutory objectives, which is basically encourage competition, ensure market integrity, and adequate protection of consumers. So none of that answers that question, frankly. Those are our objectives. But I think it's a really tough one. I don't think that there is, to a degree, the sustainability drive, as it were, might be a partial answer to that. I don't think that really in the UK, in Europe, or in the US, say, or in the Western world, and possibly also in the global south, as it were, I don't think there is a convincing program around social equity. Because if you look at what we're actually doing here, and we've discussed it, we're saying very traditional. There's no fiscal headroom at all, so we can't use the normal levers that are available to us. We can't borrow, we can't tax more, we can't cut spending. Therefore, it's growth, and we're just going to work to deliver growth through structural measures. None of that, and well, the hope is if you grow the pie, then people at all levels of society will benefit, basically. But that's not really dealing with
Not resetting anything.
resetting at all. That's,
Yeah, I think the delicacy we're in is, to the point raised, we're coming in with a legacy of this transition that we're talking about, which means some of these traditional tools you've got. In reality, we've had 10 years of just keep pumping money into the system. I think the real question for me, to answer your point on fairness, equality, redistribution, comes back to inflation. Because if you look through the 70s experience, there's a real and a nominal. And actually, if you don't have assets, the nominal is quite important for you. And we got through most of the 70s with good GDP growth, good wage numbers, because if you're in a nominal world, and that's what we're seeing at the moment, I mean, wage inflation is high, it's one of the drivers. So actually, if you don't own assets today, but you actually are able to participate in the economy, your wage is actually pretty strong because it's nominal. The underlying growth rates are fairly nominal. It's why the corporate profitability is held up well, because that's nominal. And actually, what we've seen, I think the phrase was, you drown in a bubble bath if you own assets, because ultimately, although the nominal number looks okay, the real number is horrible because we have a big inflation point. So I think where the
Gareth,
government...
May I just make a comment just on that, a really short one? If there is a silver lining at all to a high inflationary environment, it transfers wealth from the older in society to the younger in society. By the way, I'm not an economist either, and in fact, many of us aren't. So I think we're all able to kind of have, hopefully this sort of dialogue and conversation. But I think it is. So I think governments, maybe to answer your question, do have a fundamental role, and those are elected by people in the room. But you're going back to your point. Inflation does move wealth around.
Yeah, I was going to say, A, this wealth transfer, and B, I think the delicacy for the government right now and the central banks right now is, we know the playbook to deal with inflation, but it's going to be very painful because it's a hard landing, a recession, unemployment, and everything that brings to deal with it. Or is there a narrow path we can walk down where you can gradually bring inflation down? To your point, you have this wealth transfer, because if you own assets, they get diluted down in real terms because of everything that's happening. If you look at stock markets, everything else, it was gold, oil that actually performed in the 70s. And so I think that's where this government and the central bankers and this society have got to make a decision as to where's the tipping point between getting inflation to a place where cost of living, et cetera, is okay, but you keep nominal wages high, and we start this implicit transfer of assets from X to Y without a disruptive slowdown.
Just a
quick comment.
really
Yeah,
quick one, which is not probably an economic point at all. I'm not an economist. I studied English literature here. And I've been in communications and public affairs and lobbying, probably for some of the baddies all the way through. But I think there's a massive question here about a just transition when we talk about the energy side, when we talk about social change, when we talk about intervention. And I think the government's role has to be, whatever the government is, to actually communicate, deliver, get out the vote, and interact with the voters and represent them in a much better way, because there is enormous skepticism, lack of voter turnout, and and how can that really work for anybody's benefit if there isn't pressure on governments to do the right thing?
So we're running out of time. I've got one question here, and then possibly one more, but one here.
Hi. Can you hear me?
Yeah, please introduce yourself.
Yeah, hi. My name's Ollie. I'm a third-year medicine student, so I'm probably not very qualified out of the people here. But I just want to ask a question mainly to Ashley about regulation. Sort of everyone's mentioned sort of that there's a big drive for regulation sort of going into next year and also sort of through the past few years as well. But I want to ask sort of what is the impact of increased regulation on some of the smaller players in sort of the market and the industry, especially sort of in terms of investment managers and sort of in houses, obviously large companies are more able to deal with sort of large numbers of regulation, but what do you think sort of is there a balance to be had? What is the impact on sort of those smaller, maybe even like sort of the IFAs, independent people? Sort of what is the impact on that?
Yeah. You don't have a relative who's an independent financial advisor.
Maybe. I'll keep quiet about that one.
Actually, I'll give you a fairly trite answer to that, but it's a real one, which is we are starting as an organisation to look much more seriously at the word proportionality. Not that we intend to be disproportionate, because that would be silly, but basically what it boils down to, if you look at the size of a firm and its overall impact and complexity and such like, and then you look at who is it serving. So the larger firm would often require a lot more focus because its activities are more complex and have higher impact. The smaller firm, not so much, but then it rather depends on who they are serving. So if they're serving institutional clients, so it's within the city, basically, that's an area where we might not be as vigilant around outcomes as distinct from if they're serving vulnerable consumers. So that's really the approach. We haven't taken it to date that explicitly, but that's what we're about to do.
And just linked to that, I think if this country is going to get back to where we want it to be, we need to have more ownership of equity. If you go to the US, 20% of the NASDAQ every single day is retail players punching around. The equity ownership, partly through the pension funds, has gone to literally nothing in this country, so no one's got any stake in this at all. So the other part is actually to deregulate, to be able to allow individuals to take more risk and actually have more of a stake in the equity market.
But if you allow individuals to take more risk, we've got a very, very broad, unusually broad compensation system in the UK. It's a very, very difficult discussion to try and haul that back so that individuals take responsibility for their own decisions to an extent.
Yeah.
I mean, obviously, we regulate firms, but that balance is not right at the moment. So.
I think we're almost there. Did you have a question down here? Yes, there's one question just down here. I think we're going to have to make this the last one, I'm afraid. The gentleman in the white top. This is where I get to be like question time. It's really good fun, yeah. Gentleman in the white zip-up top, about 5 rows back. Yeah, thanks. You just wait for the microphone and then introduce yourself. Thank you.
Yeah, thank you. So I'm Melvin, a second-year economist here at Downing. And there's been some discussion about AI and particularly the defensive regulatory stance of governments. I think my question is, what then should governments do to support the rise of AI? And perhaps more generally, is regulation necessarily harmful to the development of industry?
Thank you. Admirable question. Who wants to have a stab?
I mean, I think that one of the things we were talking about the information being available to help with the drive towards ESG and so forth, is a critical area where you could actually create a positive environment for AI to help that information process, availability and data analysis. Because one of the things I hear all the time from businesses there's an increased, as there should be, an increased burden and responsibility for us to actually state what we're doing, prove the evidence, make our plan visible and transparent, and report in on our progress. And with very complex businesses at scale, it's very hard to do unless you really deploy that type of analysis and AI. It certainly can help the process. So setting up something like a corridor or an ability to actually drive that forward would be something I think that could be extremely helpful. And then you can keep the other, let's call it defensive regulation. Absolutely, it should be there. And I don't think anybody would argue against that. But have some sort of corridors where you can see where AI could actually help deliver the objective.
I think the biggest value creation globally has been in technology, and that goes back to the big fangs in the US. If we're going to succeed in this country, and we've got all, again, the intellectual capital to do it, all the history to do it, we need to create a regulatory environment and a framework that allows us, A, to support businesses as they're innovating and growing, because the growth of these businesses is rapid. It's 1 or 2 years, and you're suddenly at 10, 15, 20 billion. It's not 50 years that we have to do in a lot of industrial business. So I think for this country to be right, we've got to get the regulatory framework right. We've got to get more capital to support venture, because the listing location debate, these companies are all listing in the US because it's West Coast US venture capital that's funding them, and they're coming out of Cambridge, they're being funded by the US, and then the natural thing is you've got to go to NASDAQ because that's what we do here. So I think that's the cycle we need to break with the right environment, but it's got to be encouraging capital, get more private capital into these, and then let's incubate, innovate, and retain them here in the UK so that they're good listed champions in our stock market.
Yeah, we see regulation as being an enabler.
Yeah.
It's not something that is designed to suppress. And there's often, I think, a kind of misconception around that. And in enabling, we've touched on it earlier, this question of mobilizing domestic capital in order to create a virtuous circle of the productive use of savings, domestic savings, and then into Cambridge research. I mean, ARM, that's what it was originally. I think that's the first thing. The second thing is in relation to AI. Again, it's an enabler. You've got to work out where do the risks lie, and where are the expectations on effectively big tech? What are the expectations to ensure that those risks are identified and contained, which then enables it to flourish? Because if you don't do that, what happens is that very, very quickly the risks mature and it could be a bit of a disaster. So that's why I'm quite in favour. You'd expect it, wouldn't you, because I'm a regulator. But that's why I'm quite in favour of enabling regulation, or regulation as an enabler for this.
Well, on AI, I think it can be going to the actually enabling businesses and smaller businesses. We've talked a lot about big businesses. But I think AI has the potential to enable smaller businesses to act as if they're bigger businesses, as in, produce content, produce creative adverts, produce marketing campaigns. So if you sort of think how, you used to have a retail shop on a high street to sell goods, you can now do that clearly on the internet and you can be quite a small home trader to do that. AI. So in terms of the enabling, I think actually teaching, in inverted commas, and educating smaller businesses that AI could be something for them, and it's not just about big tech and big government and big regulation. I'm not sure we're getting that message out.
Well, thanks. Right, that's been absolutely fascinating. Let me hand back to our master for a few closing words.
Thank you very much for that. Yes, I am going to wind up. Thank you for a fascinating discussion. I always find events like this, you listen to all these different ideas and opinions, and you may be feeling really quite positive, a glass half full, or even very full, or actually quite negative and pessimistic, and you may feel you want to drown your sorrows. There will be an opportunity to do that in a minute, downstairs in the Grace Howard room, where drinks will be served. But before you go downstairs, can you please join me in thanking our chair and our panel for a fascinating debate. Thank you very much.
Thank you.
Can I have a drink of the chair?
Shepherding.